This is the gold price chart. If you had invested $100,000 in gold around 25 years ago, you would now have $1 million. That's a 1,000% return on a safe investment.
Gold prices are breaking records everywhere.
Gold prices in India surged to an all-time high of rupees 76,700 per 10 grams on Wednesday, perhaps reflecting global trends.
When it comes to gold, we are trading at all-time highs in the Asian markets right now. It is hit above $27-30 an ounce as well, and still counting. It has been a very strong gain there.
Gold is at all-time highs. Silver is at 12-year highs.
This year for gold prices, it actually has outperformed various other asset classes, including Nifty and Sensex as well, by the way.
With central banks around the world easing monetary policies and concerns about economic stability, gold's appeal as a safe investment continues to grow.
Gold is big business in India.
What makes gold so special? Gold is special as it has always been perceived as a risk-off asset, but its significance goes much deeper. Therefore, it has consistently been seen as an inflation hedge, a crisis commodity, and a refuge for investors during times of economic uncertainty and geopolitical tensions. Even before the establishment of the gold standard, gold was recognized as a means to protect wealth during challenging times. But it wasn't just a matter of perception. Gold has a long history of serving as a stable form of value. Therefore, even after the decline of the gold standard in the 20th century, gold maintained its status as a reliable store of wealth and a safeguard against rising prices. In the 1970s, inflation surged dramatically, but gold proved its resilience by maintaining value. Therefore, between 1973 and 1979, gold prices rose by 35%, outperforming many other assets during this period of high inflation. But this wasn't just a fleeting moment, it reinforced gold's reputation as a hedge against inflation. During financial turmoil, investors often flock to gold, but this tendency is rooted in historical evidence. For instance, after the economic crisis from 2008 to 2012, gold prices soared from around $1,100 to over $1,800 per ounce. Therefore, the demand for gold as a safe haven significantly increased, illustrating its enduring appeal in uncertain times. So what is driving up the value of gold? One of the main reasons is the central banks buying gold.
Therefore, this trend highlights gold's role as a fundamental asset in strengthening financial systems against potential crises. As geopolitical uncertainties rise, gold becomes even more attractive to investors. But it's not just individual investors. Central banks are increasingly focused on gold amid concerns about global monetary policies and creating escalating debts. Therefore, this collective shift towards gold underscores its importance in safeguarding against market volatility. Gold's value extends beyond finance. It is also crucial in technology sectors such as electronics and aerospace. But this demand helps to sustain gold's relevance in a rapidly evolving economy. Therefore, gold's multifaceted uses ensure that it remains a valuable asset in various contexts, solidifying its special status in both investment and technology applications. In this study, we will look into the history of gold from 4000 BC to the 1900s, how gold changed over the last 125 years, why gold is perceived as a safe haven, will the price of gold collapse, and finally, price predictions for gold over the next 25 years. History of gold 4000 BC to the 1900s. Gold has always held immense significance throughout human history, serving not only as a symbol of wealth and power, but also a crucial medium of exchange. Its unique properties, scarcity, beauty, and permanence, made it an ideal choice for currency and trade. But this evolution from decorative objects to a standardized form of currency reflects its integral role in shaping economies and societies. Gold was first discovered around 4000 BC, but it was primarily used for decoration and making religious idols. Because gold often appears in its pure form, it was easy for early humans to manipulate, but this ease of use also meant that it was highly valued. First coins made from a mix of gold and silver, known as electrum, were created in Lydia around 600 BC. This was an important shift away from a direct trade of goods, but it also marked the beginning of a more structured economy that relied on coinage. During this time, gold became the main currency in the Roman Empire, but it was aureus, a gold coin that facilitated trade over long distances and bolstered the economy. After the fall of Rome, the Byzantine Empire continued the widespread use of gold, but the introduction of the solidus became a common currency that greatly influenced trade in Europe and beyond. Gold was not merely a medium of exchange, it also symbolized divine favor and was frequently used in religious artifacts and also on royal decoration. But this cultural cachet further solidified its importance as a sign of power. The introduction of gold coins like the Venetian ducat around 1284 helped to boost trade across Europe. But it was also a time of greater commerce due to advancements in banking systems and the establishment of trade routes. The quest for gold spurred exploration during this period, but European nations were not just looking for wealth. They aimed to expand their influence by establishing colonies in the Americas, which significantly altered local and global economies. Gold began to be recognized as a standard of currency across Europe, which helped to stabilize economies, but it also paved the way for improved international trade relations. The discovery of gold in places like California in 1848 caused a massive influx of people, but this movement led to economic booms and a remarkable increase in global gold production. By the late 1800s, many countries had linked their currencies directly to gold amounts through the gold standards, which made international trade easier. But it also created a more stable currency system that many nations relied upon. Countries rich in gold gained a significant political and economic strength, but the competition for this precious resource often led to conflicts and disputes over territorial and economic dominance. How gold changed over the last 125 years. In the last 125 years, the price of gold has undergone significant changes from 1900 to 2024. But these fluctuations have been influenced by a variety of factors such as economic conditions, world events, and the balance between gold supply and demand. In 1900, gold was priced at approximately $20 per ounce, but this was during the era of the gold standard, which tied the value of money directly to gold. Therefore, while gold prices remained relatively stable, they experienced some fluctuations due to external pressures. During World War I, 1914 to 1918, economic instability caused some price fluctuations, but gold prices remained mostly stable until the war concluded. However, the 1929 stock market crash prompted the Great Depression, leading to a surge in gold prices as people sought safe investments. Therefore, by 1933, the price had risen to around $35 per ounce after President Franklin D. Roosevelt abandoned the gold standard for domestic transactions. In 1934, the Gold Reserve Act set the official price of gold at $35 per ounce, which remained fixed until the early 1970s. However, the post-World War II economic boom and the Bretton Woods Agreement created a new monetary system that tied currencies to the US dollar, which could be exchanged for gold. Therefore, this arrangement helped keep gold prices stable. In 1971, President Nixon entered the dollar's convertibility into gold, allowing market forces to dictate prices. This change led to a sharp increase in gold prices due to factors like rising inflation and global tensions. Therefore, by January 1980, gold reached an all-time high of about $850 per ounce, driven by inflation exceeding 13% and also oil crisis and widespread economic uncertainties. In 1999, prices dropped to about $253 per ounce, influenced by a robust US economy and dollar, alongside central banks selling off their gold reserves. Therefore, the early 2000s witnessed a recovery and growth phase. From 2001 to 2008, demand from the emerging markets like India and China increased, but global economic instability also played a role. Therefore, by late 2008, during the financial crisis, gold prices surged past $900 per ounce. In September 2011, gold hit around $1,900 per ounce amid fears of recession and European debt issues. But between 2013 and 2015, prices fell sharply due to economic recovery and rising interest rates, dropping to approximately $1,050 per ounce by December 2015. Therefore, the market was highly reactive to economic signals during this period. The COVID-19 pandemic in 2020 caused significant economic disruptions, leading gold prices to soar over $2,000 per ounce in August, as investors sought safety. However, in 2022, prices fluctuated between $1,700 and $1,900, influenced by inflation and a strong dollar. Therefore, by the end of 2023, prices had rebounded to approximately $2,000. As of November 2024, prices have averaged around $2,700 per ounce, driven by ongoing inflation concerns and geopolitical tensions. Therefore, the large landscape for gold continues to evolve. Gold is perceived as a safe investment during economic downturns, but it is also sensitive to overall economic health. Wars and political instability often increase demand for gold, but peace and stability can lead to decreased interest. The amount of gold mined and available on the market significantly affects its price. Therefore, supply constraints can lead to price increases. Interest rates play a critical role in gold's appeal. Lower rates typically increase demand for gold since it does not earn interest. Therefore, shift in monetary policy can have a profound impact on gold prices. Gold is considered a safe investment in 2024. Gold is considered a safe investment in 2024 for several compelling reasons, particularly in the light of ongoing global economic uncertainties and rising inflation. Gold has a long-standing reputation as a safe haven asset, but this reputation is especially relevant today. During times of economic turmoil, such as the current geopolitical tensions stemming from the Israel-Palestine conflict and the ongoing Ukraine war, gold prices tend to remain stable or even increase. Therefore, the recent surge in gold prices from approximately $1,800 to $1,983 per ounce, reflecting a 5% uptick in just a few weeks, demonstrate how gold responds to heightened uncertainty. But this stability makes gold an attractive option for investors looking to protect their wealth against inflation, which is currently hovering around 3.7% in the US, well above the Federal Reserve's target. Historically, gold has maintained its value over centuries, but this historical performance is particularly important today. Unlike paper currencies that can depreciate due to oversupply or shifting economic policies, gold's intrinsic value remains consistent. Therefore, over the past 5 years, gold prices have doubled, demonstrating its potential for long-term appreciation. But a significant increase in gold prices in India from around 60,000 rupees to 78,000 rupees per 10 grams within a year, marking over a 30% rise, further underscores gold's reliability as a store of value. Gold also serves as an effective diversification tool in investment portfolios, but it stands out for its unique characteristics. It typically has a low correlation with other asset classes like stocks and bonds, which means it can reduce overall portfolio risk during market downturn. Therefore, as equities become volatile with rising interest rates and inflation concerns, gold often performs well, acting as a buffer against potential losses in other investments. Gold is one of the most liquid assets globally, but this liquidity is crucial for investors. Investors can buy or sell gold quickly without significant price fluctuations, making it easier to convert into cash when needed. Therefore, this liquidity adds another layer of security for investors, ensuring they can access their funds when necessary. Potential for a collapse in gold prices is shaped by various factors, but economic conditions, geopolitical events, and investor sentiment stand out as particularly influential. Gold prices often rise during times of economic uncertainty, but this trend is not guaranteed. For instance, during the COVID-19 pandemic, gold surged to an all-time high of over $2,000 per ounce due to heightened demand as a safe haven investment. Therefore, while gold thrives in tumultuous times, significant interest rate hikes by the US Federal Reserve to combat inflation could lead to a decrease in gold prices. According to Goldman Sachs, if economic conditions stabilize and interest rates rise, gold may struggle to maintain its value, but this could potentially result in a significant drop in prices below current levels. Conflicts and global tensions typically drive investors toward gold, but the opposite is also true. The World Bank has noted that escalating conflicts in the Middle East could increase uncertainty and lead to high gold prices. Therefore, as geopolitical tensions rise, gold may benefit. However, if these tensions ease, investor confidence may return to equities and thus demand for gold could diminish, which could lead to a decline in prices. Market psychology greatly influences gold pricing, but this influence can be unpredictable. For example, heightened speculation or substantial buying from central banks can push prices upwards. Morgan Stanley has indicated that central bank purchases are a significant driver behind current bullish forecast for gold, predicting the prices could exceed $2,600 per ounce by the end of 2024. However, if investor sentiment shifts towards risky assets due to an improved economic outlook, gold could face a steep decline. What will gold be worth in 25 years? Gold price predictions differ widely in analysts and institutions, but they are all influenced by a variety of economic factors and market conditions. Goldman Sachs had previously predicted that gold could reach around $2,700 per ounce by early 2025, but we are already seeing those prices now. So gold is already outperforming. This is contingent on expected interest rate cuts from the Federal Reserve and increased demand from central banks. Therefore, they assert that gold serves as a hedge against financial risk, especially during periods of economic uncertainty. Looking ahead to 2030, Goldman Sachs suggests prices could soar to even $9,000 per ounce, which reflects a long-term bullish outlook fueled by a rising demand and diminishing supplies. JP Morgan shares a similarly optimistic view. Their analysis is based on a structural bull case for gold, which they believe will persist due to ongoing economic pressures and potential Fed rate cuts. Therefore, they expect prices to climb steadily, indicating sustained demand and limited supply. Citigroup offers another bullish perspective, projecting gold prices will reach around $3,000 per ounce due to factors such as weakening labor market and disinflation trends. They emphasize that financial flows into gold will expand as investors seek stability among economic fluctuations. Light Finance adds to the optimism with predictions that prices could rise to $4,600 per ounce between 2026 and 2030. But this is based on ongoing market trends favoring precious metals. Looking further ahead, some analysts, including those from AXI and Goldman Sachs, predict gold could soar to $6,800 by 2040, whereas other forecasts that it might exceed $10,000 by 2032. Therefore, the overarching trend suggests that as global economic uncertainties persist, gold will continue to be a preferred safe haven asset. Gold would have made you a millionaire in the last 25 years. Are you ready to go all in on gold today? Let me know in the comments.